Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. We've had a great response to our previous episode with Lord Mervyn King, and thanks for all the comments people sent. Make sure to spread the word of our Macro Hive podcast show so others can get the benefit of listening to them too. Before I talk about this episode's guest, I wanted to mention a few pieces we put out this week on the Macro Hive website. First, markets are getting nervous about second waves and renewed lockdowns, especially in the US. And so we have an excellent piece by Dominique Dore-Foucault, where she gives her more optimistic take on these developments. Second, we have rates guru George Congalvis writing on foreign demand for US treasuries or the lack thereof. Third, we expand our US election tracker to include battleground US states, and Biden is certainly doing very well in those. At some point, the market will start to get nervous about a Biden win, so make sure to follow our tracker on our site. Then we also have pieces on trends in US jobless claims and also a view on potential UK VAT tax cuts. So lots of great content, and make sure to subscribe to the site if you haven't already. It's less than the weekly price of 4 scoops of ice cream from those ice cream shops that seem to be popping up all over the place. On to this week's podcast guest, I have Saeed Amen. He is the founder of Q Macro, which provides investors with quant research and analysis. Over the past 15 years, he's developed systematic trading strategies at major investment banks, including Lehman Brothers and Nomura. He's also the author of Trading Felicians, What the Ancient World Can Teach Us About Trading Today, and he's the co-author of The Book of Alternative Data, which is due out later this year. He's presented his work at the ECB, IMF, Bank of England, and the Fed, amongst other institutions. He's also a visiting lecturer at Queen Mary University of London. So, on to our conversation. So welcome, Saeed, to our podcast show. Thanks for agreeing to come on.
Thanks for inviting me. So I'm excited to take part in this podcast.
So, Saeed, you're usually one of my go-to people for all things quanti or alternative data-esque or even Python. So I'm going to touch on all of these topics in today's podcast. And I thought maybe we could start on the modeling side, on the trading model side. You've done extensive work on that over the years. And maybe we could start with you describing some sort of typical trading models that you've worked on or you understand investors tend to favor. And then from there, we can delve a bit more deeply into them.
I think there's several places where I would start if I'm looking at trading strategies. And here I would refer to what I would kind of the more like the beta strategies, kind of the more well-known trading strategies. So of them, one which is particularly well-known is a trend following strategy, which is adopted by many of the CTAs around the world. Obviously, in practice, when they do it, they'll have kind of modifications and special ways that they execute to reduce transaction costs. But at essence, I think that's kind of a place where you'd start if you're basically developing a trading strategy. And then going on from that, at least within FX, you have carry. You also have the concept of carry in many other asset classes as well. That's another important place where I would look if I'm looking to develop my first steps in trading strategy. And then from there, you also have value, at least within FX. I think value is one of those strategies which is very long term. So you're not going to put on a trade recommendation because your value model says, okay, the dollar is overvalued here, something like that. It's more a case of having a very long-term view and potentially having something additional in your portfolio. I wouldn't advocate for people purely to use a value style model within FX or other asset classes. But I guess the point is when you build these models, they end up complementing each other to some extent. So if you end up having a trend following model, potentially it will be complemented by a carry model. So at least historically, although it's not always been the case more recently, when trend does very well, say within the crisis, then say carry underperforms. The recent price action has actually been relatively difficult for trend because the move in stocks to the downside and then back to the upside was very quick. So it wasn't something that type of model would necessarily pick up. So you have your more typical, I'd say, beta style strategies. So, and I've not outlined all of them there. Just give a very quick introduction. But then you have kind of more your alpha style strategies, which require a lot more work. They might use alternative data. They might be just for specific assets as well. So there, typically, your Sharpe ratio might end up being higher. But maybe the capacity might be lower. It simply might take more time to implement. So that's the way that I would break up the two types of strategies, some which have become more beta over the years and more well-known, and kind of the more specialized, idiosyncratic type of trading strategies.
If we focus a bit on the trend following strategies, some of the conventional ways of capturing trend, one would be simply to look at moving averages. So maybe that could be a moving average crossover off FX markets or equity markets. Another strategy people sometimes use is what's called like look back windows, where you just look at the percentage return over the past month or past 3 months. What do you think about those kind of fairly simple ways of following trend? Do you have a view on those?
I think in terms of the actual signal, it's not necessarily the case that it has to be very, very complicated. So the one with the look back window, there's actually a really good paper called Demystifying Managed Futures. And they, for example, use a look back window in that one. But the thing is, it's lots of different ideas that come together. So one is how you create the signal, whether it's a look back window or double moving average or something like that. The second thing that you need to think about is how you allocate risk to the various assets. So even this is true of your discretionary trading as well. It's not purely the directional move that you're interested in. It's more how much you leverage up. So there, particularly, you're looking at things like vol targeting. And it's actually very stark. If you look at trend following portfolio across many different futures, if you include vol targeting or you just have equal notionals, the risk adjusted returns are very different. So a lot of the juice from the strategy actually comes from the way that you allocate between the various assets within your portfolio. And then also the breadth of assets that you trade as well. So if you're only trading FX, then typically you're not going to have as strongly performing off-it model compared to doing all the different asset classes when doing trend following. So it's kind of not as glamorous to think about, oh, I need to trade more assets, but that's actually the simplest way that you actually improve your Sharpe ratio. So it's not one specific thing. It's not necessarily just the look back window. It's not necessarily just the volatility targeting. It's all these things that come together at the same time. And then potentially, if you want to improve the model, there's two ways to it. One is you trying to improve your trend following model, tinker with it, maybe have different risk allocations or also better execution as well. And that's particularly an issue if you're a very large fund. There, you'd want to spend a lot of time and effort to improve your execution. But the second way is just to add additional models, which are not necessarily trend-based, that you hope will be orthogonal and decorrelated. So I'm probably of the view that you probably don't want to just have one really complicated model. It's kind of nicer to have several different models that are based upon different ideas and then combine them together in a portfolio.
One of the challenges with all of these types of models is the problem of data mining or in-sample optimization, where you have your spreadsheet with all the data. And of course, you can tinker with all the variables in a way that will give you a really impressive return or Sharpe ratio. How do you avoid manipulating the data too much?
That's a very difficult question, but it's also very, very important. So I'd say, first of all, it's important to have a hypothesis when you develop a trading strategy. So that I would say is a good point, because the idea behind the hypothesis is that, let's say you have an infinite number of trading strategies. You have a hypothesis, you're immediately pruning your search space. And you're saying, actually, we're going to remove all the other trading strategies from our search space. So potentially you might miss stuff if you do that, admittedly. But the idea is, if you have a hypothesis, hopefully you'll just be left with the strategies that make the most sense.
So what would an example be for a trend following strategy? What type of hypothesis could one have?
So the hypothesis with a trend following strategy, you could have a behavioral bias, saying that when people see the price action moving in one direction, then potentially people want to jump on the bandwagon, and like kind of this whole fear of missing out and that type of thing. So that's the hypothesis behind, say, why trend following works. Then you have, say, a carry rule. Well, the reason why you make money from carries, you're basically extracting a risk premium, because essentially you're picking up pennies in front of the steamroller. So it kind of explains why you're making money, but equally explains the drawdown aspects at the same time. So you're basically coming up with a hypothesis. So you might have a hypothesis, say, about something very specific, like it could be, say, remittances. So you might be looking at Mexican peso or, say, Philippine peso, and saying, well, I think there's a relationship between remittances and the currency, which kind of makes sense from an intuitive perspective. But then you need to go and think, okay, when would these remittances be likely to happen? Are they large enough versus the other flow to impact the price and that type of thing? So you generally start with a hypothesis and then go back from that. Admittedly, I have heard of instances where people just data mine the data and they actually do make money out of it. And I guess that potentially could work for some people. I think the flip side of that is when that type of strategy starts to lose money, it becomes very difficult to continue putting risk on it. If you don't really know why it's working and you just have a black box, and it becomes very challenging to understand actually maybe I should go to my boss and say, we should keep on running this. But if you can't explain why, it becomes difficult not only for your management team, but also external investors.
Do you think that these sorts of strategies, say the beta ones, could become too crowded, and through crowding in those strategies, the returns disappear? Or do you think the returns are such that it really is a beta where it doesn't really matter how much capital goes into it?
I think there is an issue where potentially a lot of crowding could render these strategies more problematic. So even for carry, if everyone's trying to chase the same risk premium, or let's say vol selling, well, there's not going to be much of a risk premium yet left to capture. I'd say purely looking at carry, you can see that in terms of just say G10 carry. There's not really much carry between the high yielders and the low yielders anymore. So that in itself, the market conditions are making it more difficult to extract any sort of risk premium from that. But I think there can be a potential issue with crowding. And I would say in particular with the more nuanced trading rules, like kind of the more alpha-based trading rules, where you're chasing some very specific type of behavior. There, it's a lot easier for the needle to be moved such that it becomes quickly loss-making. But I guess it's a simple rule of thumb. The lower frequency it is, generally speaking, the more difficult it is for crowding to impact, and potentially the more capacity it has.
And there's been certain strategies that had been doing well in earlier decades, but have done less well more recently. So one is trend. If one looks at, say, G10 FX markets or indeed some other markets, momentum has actually performed quite poorly over the last 10 years. Another one in equities is the value type strategies in equities. What's your view on that?
The thing is, I think with trend, there have been some, I think you're right that the past few years have been a bit more difficult, I think, for trend. But at the same time, I don't think necessarily you want to totally remove it from your portfolio. I'd say with trends, in a sense, it's meant to be part of your portfolio in any case. Like I wouldn't advocate it even before when it was performing. Because if you only look at one factor, whether it's trend or value, you're ignoring all the other factors at the same time that are going on in the market. So I would say this probably goes back to the point that you shouldn't basically put all your eggs in one basket. You should look at several different factors when it comes to developing a trading strategy.
One kind of message that's coming through from what you're describing is just the importance of diversification of models rather than over-optimizing just one model and sticking with one.
I would say that's really key. And particularly when you have, say, lower capacity strategies. Like I remember in the past when I was working at banks and working with the traders. So I guess this was a time when potentially you could run more internal risk. But in any case, it was mostly FX spot in any case. So there, the idea would be that we'd run lots of different models. And then potentially you can diversify your risk that way. Obviously, the issue there is it takes a lot more time in terms of research. Whilst if you have one model, I guess it's not as much time. But the key point is to keep on having research time to be allocated, to keep on coming up with new models, new ideas, and add them to your portfolio as you find them.
And what are some examples of some alpha models? You mentioned remittances as one kind of interesting one. Are there kind of other interesting alpha models that you can disclose?
I guess a lot of people know within the FX market, and maybe it's no longer really an alpha model because everyone kind of talks about it. You see a lot of Bloomberg articles about it these days. It's kind of the idea of the month-end flows and trying to model them and the impact that it has on FX towards the end of the month. So I guess originally, when I was at Lehman, that was probably very much an alpha strategy. But over the years, every single bank has tried to come up with their own versions. So that's an example of, I would say, of a very particular type of alpha strategy. It can also be the case you might have alpha strategies where they're using a data set that not many people have access to and everything. But that's kind of the nuanced type of approach that I would say is more of an alpha strategy.
On the month-end flow type model, one thing that has become much more popular in markets today are CTA models or predictors of CTA flows. Where there's a sense that there's a large amount of model funds or CTAs in the market that are following signals. And so if you replicate their models, you can then anticipate their likely signals they're going to get. And as a result, you can work out the expected flow or the flow that could get generated from those models. So there's lots of organizations are coming up with such models to predict those flows, similar to month-end flows, I guess. What do you think of those sorts of models?
That's how it's broadly classify that within the same category. So the idea is you try and build up where you think there will be an expectation of a flow and then potentially have a trading rule on top of that, or at least to have prior warning or some sort of indication, essentially. So I think that's definitely something that people look at. I guess within equity space, people look at things like ETF rebalancings as well, very common. So that's another thing that people look at. Again, these types of trading strategies are kind of lower capacity. They're more nuanced. Like if you're a big fund, you can't really allocate everything to these types of strategies. Maybe if you're a small fund, potentially you could allocate capital to all of these.
You touched on execution as also being an important factor in returns, especially, I guess, for high frequency models and larger funds. How do you go about improving execution?
I guess the key point is to actually think about it to begin with. So some of the reasons that people are looking at this is because of regulatory issues, things like MiFID II, because you need to show best execution. But I would argue that even without regulatory issues, you should be looking at transaction costs, because there's two ways to make money. Either is to generate returns, or secondly is to save costs. Again, trying to save costs is not kind of as glamorous or fun, but ultimately you're going to give a payoff to your investors. So whichever way you give the payoff, I'm sure your investors are going to be happy. So one way is to basically analyze your trading data and to do transaction cost analysis. I've done a lot of work in this area. I've developed an open source Python library called TCA Pi, which does this, say, for FX. But the point is you still need to be proactive. So if you do your transaction cost analysis, you use my library or use any other TCA service, or you do your own, but you need to react to it. So if it's telling you that, say, one broker tends to end up having more market impact or more slippage on your trade, you need to actually be active and to go back to them and ask them questions. So it ends up being like a circular process. So you do the analysis, then you basically see what you can improve, and you keep on going around like that. It's not something that you just do as a one-off. So again, it kind of takes time and effort to improve that.
So you mentioned you've created some code around this that you've made open source now. So someone can take this for free, this code that you have, and they could apply it to their strategy or their execution and determine to make some improvements in their transaction costs.
Yeah, basically. So I originally did it for a large asset manager, but they very kindly allowed me to actually reuse the code and to open source it. So I thought for me, it would be an interesting way of reusing the code and potentially improving it as well. So it's more open, and then potentially I can do consulting around it or something like that. But I guess, yeah, the key point there is you need to have your trade data, you load it up, you load up some market data as well, and it will give you breakdowns in terms of like what type of algo has worked best historically for you, what type of broker has worked best for you. So, but it needs people to actually go and load up the data and to spend time.
Okay, so there's kind of no free lunch, so to speak. You've got to put the work in the end. And as you say, you've got to keep updating it, and you have to act on the information you get. It's not just a one-off silver bullet that improves everything.
Ultimately, you don't need to spend years developing the code. I've done that, or there's other service providers as well do that. Basically, it's like a form of research. That if you get really great research from research analysts, maybe from Macro Hive, I've been reading lots of your articles, you need to actually read it and take it on board. Then it influences how you do your trades and your ideas ultimately. That's the process. So you need to actually take it on board and spend time doing it. Because ultimately, if it doesn't alter your behavior in any way, or it doesn't give you confidence, this is any sort of research, I would say probably it's not something you're making full use of.
Now, you've done a lot of work on alternative data as well. And in fact, you have a book, I think, coming out later this year.
I've co-written with Alexander Denev the book of alternative data. So that's going to be out in a few weeks, in late July. So it's going to be published on Wiley. So it's earlier than we expected.
Yeah, I was looking to try to buy it, but then I realized you have to pre-order. It hasn't arrived yet, so to speak. But obviously, alternative data has become like a huge thing over the last 10 years. I keep getting contacted by these vendors who are trying to promote or sell alternative data. So let's kind of just go through sort of the basics first of all. I mean, how do you define alternative data?
Well, I would say alternative data is essentially any data which is not commonly used within financial markets. So if we're talking about, say, daily price data, that's obviously very commoditized. It's not alternative data. But then when you veer towards things like satellite imagery or machine readable news and that type of thing, then it becomes more alternative. Obviously, over time, certain data sets will become more commoditized and potentially they will no longer be considered alternative. So I can see in, say, 20 years' time, a lot of what we consider alternative data now will just be part and parcel of data that everyone ends up using. And I'd say the main rationale for using it is that potentially if fewer people have access to it or are using it at least, then there's less likelihood of the alpha being reduced from using that type of data sets. But again, it's not a silver bullet. So you might end up going through a lot of alternative data sets and not finding that you necessarily generate alpha for a number of reasons. And you really need to find a data set that's suitable for you as well.
And in your experience, what types of data sets show the most promise for getting alpha?
Well, I'd say there's some data sets I've looked at a lot. So one is, for example, I've looked at a lot of news data from many different vendors. For certain asset classes, I think they have become more regularly used. So potentially there's not as much alpha as there used to be. But I still think within certain asset classes like FX, I think there's probably an underutilization of alternative data. But I'd say the key trick to it is, whether it's machine readable news or any other sort of data, is how you augment it. So combining together several different data sets. So if, let's say, you're using satellite imagery for European retailer car parks, and this is actually an example we looked at in our book, that could be one way that you can generate a forecast, say, for earnings per share. But then you might augment it with other data sets, maybe one on credit card transaction data, and try to see if they corroborate each other. So I think that's the key. Potentially just trying to find one alternative data set, which is absolutely amazing, is going to be quite difficult. But it's a case of adding it as a new factor into your existing models and improving it and trying to combine them together in interesting ways is where you get the real juice.
All of these data sets, are they expensive? I mean, do you need to spend lots to get hold of them, or are there more cost-effective ways of accessing this data?
Well, I think there's many different costs. So first of all, an alternative data set is only going to be worth it if it tells you something new. So if it just tells you something you can get with a cheap data set, obviously it's not worth it. But in terms of the prices, they really vary. So I would say typically you might be, I guess a lot of them may be in the 5-figure range, maybe 50 grand, 30 grand, 70 grand. If you go into many hundreds of thousands of dollars, it's a lot rarer to find data sets of that cost. I guess the problem is when the data set costs that much, it just becomes difficult to ascertain, well, if I'm spending that much money, I really need to have a very big improvement on my alpha to justify it. Whilst with a cheaper data set, you can say, okay, well, it doesn't cost as much. I don't really need such a massive payback. This is a very simple rule of thumb that a lot of people use, and it's one that we mentioned in the book. So typically, I guess people try and look at like a return of 1 in 10. So basically, if you can make $100,000 from a $10,000 data set, or something very simple like that, whilst that's just a very simple metric, if you can make at least 10 times as much out of it, then it can be very difficult to ascertain the precise value. Unless you can come up with a very specific trading rule based upon it, then you can ascertain that. But I think when it comes to using alternative data sets for more discretionary purposes, then it becomes more difficult to put a dollar value on it.
You mentioned machine readable news. I mean, what's the mechanics of that? Is that just the case of setting up some kind of web scraping tool where you go through web news providers or social media and you kind of capture text from there, and then you sort of process that text and turn it into signals or code to then generate some kind of information? I mean, what's the process of using news as an alternative data set?
Typically, you look at your various providers, like I guess Bloomberg is one. Obviously, all the others like Refinitiv, etc., they also have something similar. So they obviously produce news that they sell to traders through terminal. They actually give you that data directly. You basically just download the files, or you have a real-time API for looking at. So they give it to you in a kind of a nice structured format. You can also do your own sourcing of data, maybe from the web. So I've developed an index for doing Fed communications. So there actually source the data from various official government websites like the Fed, etc., to actually get that data directly. That takes more work because you've got to clean a lot of the data. So ideally, I guess I'm talking my book here. So you probably want a vendor to do that for you, essentially, to structure it. But there might be cases where you want to do, there might be very specific type of data on the web that you can't find elsewhere, and then you might want to read it. So there it ends up being more of a longer process, but you need to clean all the text, essentially, and the like. Typically for data sets, or for like social media or for news companies, they have their own data sets that they can sell you directly without the need to do that.
I've had some experience with this. One model I worked on many years ago was an FX trading model based on tweets on currencies. But one of the challenges is the cleaning process, where in the tweet, somebody could mention a currency, say the euro or the dollar. Now, it could be in the context of trade idea, but it also could be in the context of something random, like somebody could say, I bought a house for $10,000 or a car for $10,000. And so then you have to somehow use some techniques to try to contextualize the data. And it takes a lot more time, especially when you have people writing in a very different or unstructured way, people who might use English as a second language, it ends up being quite tough.
It is challenging because there essentially the data is unstructured, it doesn't have a common format. Whilst I guess with a news article, it will usually be, at least with a financial organization, they'll already tag it for the ticker, they'll tag it with the various topics. So you kind of have some of that structuring already done for you. That's not to be said that you can't do it yourself, say from tweets directly, but there are many firms who kind of ingest tweets as raw data, and then they will try and do that classification for you on top of it. So to kind of reduce the time and effort that you need to spend doing that. But some people, like particularly if you're a very large fund, potentially you might want to do that yourself. You might have a very specific use case for that.
And what type of criteria should you use when somebody shares some alternative data with you? Because often things like satellite imagery or credit card data or traffic data, all of these sorts of things, they all intuitively sound fantastic. And then you think, I can do a lot with it, but often there's a disappointment when you start playing around with the data. So what types of things do you look out for to get a sense of whether the data is useful or not?
Well, I think the best thing to do is start with some sort of checklist concerning the data. So typically if you're a fund, you'll have your own checklist to go through. So the first is, what type of assets is this data set relevant for? What's the cost? What's the frequency of the data? Are there any specific legal aspects associated with it? So can they actually sell you the data to begin with? Obviously, if that's no, then you shouldn't continue any further. So essentially, you have this checklist to at least identify to begin with whether you'd actually want to get a trial of the data. Because the problem is there's way too much data. You can't trial every single data set that comes along. So that's kind of like a broad brush for identifying whether we should do additional work and trial it, or we should just leave it.
You've written a book on the subject. Presumably you must have spent a number of years doing the research and then writing the book with your co-author. What was some of the surprising things that you learned along the way in producing the book?
The thing that we realized when we wrote it is that the process of using alternative data has many different steps. It's not simply a case of finding a data set and seeing if it makes money. I've done lots of research projects on alternative data, but I'd never had the time to sit down and identify the steps. But essentially, it's lots of different steps. And a lot of them are not really technical at all to begin with. Like the first thing is you need to hire the right people within your firm. There also needs to be buy-in from the portfolio managers and newly hired data scientists that they'll work together on it. There's lots of stories of funds basically hiring massive teams, but then it's not been done in the right way, or potentially there's not been a culture fit or something like that, and it's not worked out. So just the first steps of putting together the team are actually really, really important. And that doesn't involve a single line of Python code. You need to set the stage correctly. And then from that, then you can build your pipeline. You can think about what data sets to buy. And there needs to be constant communication between the data scientists and also the portfolio managers, the end users within the business. Because ultimately, if there's not that communication, then there's not much point to looking at alternative data. Because going back to my point that essentially the only way to monetize any of these ideas is if they're traded off. If they don't alter your behavior, then what's the point?
You mentioned Python then. I know you teach Python, I understand, at university as a thing on the side that you do. And whenever we've spoken, you've always sung the joys and the benefits of using Python. So maybe let's talk a bit about Python. I guess a basic thing is that a lot of people in the financial industry use Excel as their workhorse for number crunching. Now it seems like many people are switching to using Python. So how would you compare or contrast using Python versus using Excel to do data analysis?
But one thing that I find in general is that Excel is still a great tool. And the idea is not to throw away Excel, I think, necessarily. But I think the thing is that Python can do a lot of things that Excel can't really do and improve upon. So one is when you're working with very large data sets, they can be a bit cumbersome to work through in Excel, whilst in Python it's relatively easy. And also it's just more robust if you end up writing a lot of Python code. It's kind of more robust like for production purposes and things like that. And you also get a lot of nice tools built into Python. So like dealing with time series, there's a library called pandas. You can do a lot of cool visualizations and plots, which you can't really do with Excel. So with Excel, obviously, you can do simple charts, but then a lot more complicated charts end up being quite difficult to do. And essentially, you can combine the two. So one tool that I like using is it's a free open source tool, Excel Wings. So it basically enables you to use Excel as your front end. So traders are obviously happy to use Excel. I love to use Excel as well. But then you do all the kind of the heavy duty computation in Python in the back. So you're not totally removing Excel, but you're kind of giving it a different engine, basically. So you have your, I don't know, your bog standard family saloon, but underneath it's got a V12 engine. That's the analogy. I like cars, so that's the analogy. Or I guess it should be electric motor these days. But I think it's a really great tool for people to learn. But I don't think it needs to be the case that everyone has to be an amazing Python coder. But just to do a few simple scripts and to understand what's going on underneath, I think is helpful.
How hard is it to do those simple scripts? So if somebody doesn't have a programming background, say they're an economist, say, not speaking of anyone in particular here, of course, they're comfortable using Excel, they know maths. Could someone with that type of profile be able to code in Python?
Yeah, I think definitely. One thing that I say to a lot of the students I teach is I can go and teach you Python, I don't know, maybe in a workshop or something like that. But ultimately, you can learn it, but it will also require you to spend time to sit and try and code yourself and go through problems and trying to fix. So I think ultimately, it maybe potentially can take a couple of weeks just to get up to some sort of level. But then I think to get quite good, maybe months or potentially years, I think. But if you spend a couple of weeks spending time to actually do some code, I think you can get something interesting out of it. But then every month that passes, every bit of code that you do, then you improve. And like I've been doing Python for quite a few years now, maybe, I don't know, 6-7 years. I coded before that in another language like Java. But despite the fact that I've been doing it for that long, every month or every week, I find some new library or something cool and interesting that I don't know before about Python. So it's a fun subject because there's just so many things that you can learn.
And you mentioned Java there. I mean, how do you compare Python to other languages, whether it's like C or MATLAB? People use R for statistics. You know, there's all these other environments and languages people use.
Well, I would say like something like Java. I've coded a lot of Java in the past. Essentially, it probably takes more time to code stuff in Java than it does in Python, just because of the nature of the language. But it depends. Like for some purposes, Java might be better, particularly if you're writing like a high-frequency trading system or something like that. Probably Java is most appropriate for that compared to Python. But if you're doing like a research environment, you're an economist, or you're doing stuff on a lower frequency basis, then Python is actually a good tool. I'd say R is another language that people are using, like you mentioned, for similar purposes. I personally prefer Python, but then you talk to a lot of people that say they prefer R. But essentially, I think historically, a lot of people would end up using MATLAB. And I remember when I was at Lehman Brothers, I used MATLAB a lot. But over the years, Python has evolved with a lot of new data science functionality. So a lot of the people that used to use MATLAB exclusively have moved over to Python. One reason is because it's open source, but also I think it's, as a language, I actually just very much like it. I was going to say it's not perfect, though. There are some things I would definitely want to change about Python. So it's not the fastest of languages. That's one thing.
In fact, I spoke to one of the sort of leading portfolio managers in Europe a few months ago, and he was telling me that back sort of 10, 20 years ago, entry-level graduates were expected to know and be proficient in Excel. What he's finding now is that when he hires new people into the team, like juniors in the team, he expects them all to be able to use Python. So for him, Python is kind of the new where Excel was 10, 20 years ago in terms of just the basic tool that you should really be aware of if you're at least coming into his team, which I imagine is probably similar to other teams as well, increasingly in the financial industry.
I hear very much similar things. And it's not necessarily just teams in big quant firms. It's across the street, I think, that Python is now something that people are looking for, especially amongst juniors.
Just to kind of round things off a bit, obviously we're going through this COVID period. The markets have been quite crazy at different times, especially back in March. During this time, was there anything that you've learned as somebody with a quant background? Were there any lessons you're taking away from this period of turbulence?
Well, one is market data has looked very odd over the past few weeks. But I think just economic data. So economic data has been all over the place the past few weeks, and people have really been searching for something more granular. So I think I've noticed a lot more people looking at alternative data, asking me questions about that, say, looking at data for traffic capacity in various countries to understand, is the lockdown having more of an effect or less of an effect, or looking at, say, Apple and Google data derived from mobiles again to try and understand what the effect of the lockdowns are. So I think essentially everyone is trying to drill down into kind of a lot of these tools, which maybe before quants were looking at. But but now everyone is trying to look for unusual data sets to kind of fill the void where economic data has been a bit more difficult to look at.
That's true. In fact, I mean, we've been collecting all of that data as well, all of this sort of traffic data, flight data, all sorts of data that you can imagine. So I guess in some ways what COVID's done is it's kind of brought alternative data in some ways into the mainstream. So it seems like there's a much higher awareness of this than ever before.
Yeah, definitely, because the need has kind of forced people to try and search out this data. So before it was very much a nice to have or something that you'd heard of. But now it's actually the case that, well, maybe I should have a look at it myself, maybe fill some gaps in my knowledge. So that's, I think, is the big change over the past couple of difficult weeks, I would say.
Okay, no, that's great. I think we can kind of wrap up the conversation there. And just for the benefit of our audience, first of all, how can people generally follow your work? What's the best way of following your thoughts?
So one is to, I guess, to read the book of alternative data that Alex and I are publishing. I'm also on Twitter. I tweet a lot. So just Saeed FX on Twitter, on LinkedIn as well. And my firm is Q Macro as well. If you're a developer, I'm on GitHub as well. I've got lots of open source code. So you can follow me on GitHub as well and download all my code.
Okay, great. We'll include links to the book and also your social media profile and your website as well. So with that, I'd like to thank you very much for a great conversation and hopefully you have a good launch of the book. Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.